Say it again, say, thank you, thank you. Oh, thank you, thank you. Really need to say, thank you, thank you, thank you. Mortgage Talk is on, where you receive good information for your mortgage needs, such as mortgage programs and foreclosure programs to help get you out of foreclosure. Stay tuned and hear what's coming your way. Things are going wrong. My life's uncertain. There's no place I'd rather be. Standing here beside you, my man. Your love always comforts me. So thank you, thanks for being a friend. Yeah. Over and over again. I can never repay. Love is sending my way, yeah. Some
And good evening, and welcome to Mortgage Talk. How you doing? How you doing out there in HAP TV and Twitch TV and we're working with Instagram. I don't know what's going on Instagram. We're working with you guys. We want to see what's happening there, so we can be live on Instagram. They was telling me that I didn't create a channel deal, and I said, well, wait a minute, through the other directories, we are there through them, but somehow, some way, only the audio seemed to come. We seem to have a little difficult time with the visual, so we're working on that. So hopefully we can be live on YouTube and not just the audio. Okay. Welcome to Mortgage Talk right here. We are streaming from WHPNN Radio Network. Glad to be here with you doing that, and want to give you some good information here today relating to mortgage programs. Okay, that's what we want to do. I'm going to try to get this camera thing together. Okay, there we go. Relating to mortgage programs. That's what we're talking about today. Isn't that wonderful? So I'm going to talk about this particular program, which is the Freddie Mac and Fannie Mae conventional 97 loan program. Now, this program is designed for those conventional buyers that may not want to. Okay, sorry, I kept looking up because it looked like it was going to fall. May not want to put down 20% of the loan. And with conventional, you have to put down 20% of the loan. And the reason for that is so you don't incur a mortgage insurance, or better known as PMI, private mortgage insurance. Now, very quickly, what that is, besides being a mortgage term, and that's what Mortgage Talk is all about, we are here to help promote and educate a consumer, indeed the best customer. And to do so is to understand some of the terminology. And so we share that with you on Mortgage Talk. Now, we're streaming nationally throughout the internet, and we are streaming worldwide. We stream through Blog Talk Radio, and you can always hear me on blogtalkradio.com/Mortgage Talk 1. This is where all our history is. And that's over 580 blogs at Blog Talk Radio. We also are on speaker.com. And so you can pick us up on speaker.com. We're not simulcasting right now with them, but we will be doing this show on speaker.com and simulcasting through Blog Talk Radio after we do the TV version, is what I would call the TV streaming version. Okay, so we will be doing that. Hopefully we're going to be able to hook all this up in one package and make it so easy. Wouldn't that be beautiful? And so therefore, Mortgage Talk audio is what you would have. This is like a good challenge for us on the visual screen to where you can see me face to face and hear me face to face just as well. But that's our blog, and that's what Mortgage Talk is all about. We're under the umbrella of Information Center, where we give you nothing but the facts within the facts, none of our own personal opinion, but just the facts. And so this is what Mortgage Talk is all about. I'm the host. I'm Rick Montgomery of Mortgage Talk. And man, we've been around a very long time. So we are here to give you positive and good information. This is the good time to go out and purchase home. It really is. Because see, the other shoe is going to fall. And you're going to start hearing about massive foreclosures. I've been saying this all along, and it's happening. I'm not trying to be no prophet. I'm just telling you what what's on the reel of Mortgage Talk, what's on that wheel. I'm just giving you information that's out there that this is happening. So now is the time to take advantage to get that condominium, to get that duplex, to get that two flat, to get that single family home when rates are at the historical all-time low. And this would help juice up the economy. This is the right time for you to take advantage of that situation right now. This is the time. So if you're looking for a home, you're in the right place. This is the right time, no matter what state you're in the right space to start now. The other shoe is falling. Don't know when it's going to hit the ground. President Biden has put up the $1.9 trillion rescue package that is so desperately needed. And many Republicans are fighting this package because they want to say that we've already put $6 trillion into the economy. Well, we never had this type of pandemic to ever hit the world like this and to hit our economy like this. So I don't understand why they don't get it. Because they seem to be able to get things whenever they want to get trillions of dollars to giant corporations, they seem to get it. But when it come down to incorporate the little people like us, like me and you and many others, they seem to have a hard time digesting that. Okay? So nevertheless, giving you just a brief background about Mortgage Talk and where we at and what we do and where we come from. Let's return back to our topic. I just want to just give you just a brief scenario. This particular program is a 97% of the loan program. And as I mentioned earlier, most conventional loan programs require you to have a higher credit score and 20% down. And those that qualify understand that's what they have to put down. Naturally, they can receive 5% as a gift from the bank of mom and dad. And they can also receive a credit from the seller. Okay, that's set forth by the investor. Who is the investor? Freddie Mac and Fannie Mae under this program. So let's get into the program. The conventional 97% of the loan program, the update requirement for 2021, 97% of the loan LTV, another mortgage term, which is loan to value. This purchase program that allow the buyer, now dig this, it allows the buyer to purchase a single family home, a condominium, a co-op. It allows them, or a pub, it allows them with just 3% to put down. And that's 3% of the difference of the loan, which is 3% of the sale price that you're putting down, plus closing costs. Okay? Got to say that. Some people don't like to say that. They say 3% down, and then people go to close the deal, and they find out they got to have a little bit more. So it's 3% down to close out that difference to equal up to 100%. Then it's your closing costs. Okay, got to move on. 97% is your balance of the loan that you will be owing. Now, this program is a program that was designed to compete against FHA. It was designed to compete against FHA. It is not nowhere that I'm going to be like some of the mortgage hosts on their show that seem to have a favoritism of certain programs and seem to speak more highly of others. I'm neutral in this case. I'm a 20-year mortgage broker under the Residence Inn, but it's not practically in residential mortgage brokering now. I'm in commercial mortgage brokering. And I own my own agency, which is an insurance agency. And you're going to see why insurance is so important and why it's in any and everything we do. And I'm going to tell you about some of that because it fits here today. Give you something to think about, huh? So, relating back, this program was designed to compete against FHA. But it also is for you to have options, to see which program will meet you, will meet your criteria. We talked about last week when we talked about FHA. If you missed that, you can go to blogtalkradio.com/mortgage talk 1, and that's the #1 symbol, and you can listen. Or you can go to Periscope, because I'm on there too, and you can get last week's show. And I believe that we did it here on HAP TV. This is our second broadcast. So I believe that last week was indeed talking about FHA. So you can hear all about that FHA program. However, we were talking about FHA, one of their 203K loans. But we did give you a little insight on the regular FHA, single family home, condominium, duplex, and two storage that you can purchase under that, and we gave you the high dollar amount so you can make your comparison, and we gave you the qualification too. So it's good to have more than one option that you can choose from to see which one's going to work good for you. Remember, Freddie Mac, Fannie Mae, they are the investors here, and they are insuring the loan. Okay. Now, with this particular program, as I mentioned earlier, is compared to the 3.5% down that FHA requires the buyer to do. So you may wish not to use FHA for whatever your reasons is, but you may prefer the conventional program. So what Fannie Mae has decided to do is to give you a program of an option that you can choose from. Because there's the there's the conventional program, which will require you to put 20% down. And I'm gonna tell you in just a few ticks what that benefit factor is. And you can put down the 3% program under the conventional 97% loan program, because maybe you don't want to put 20% down. Maybe you don't have the 20% to put down, but you're not going to lose any factors with this, but you are going to gain a PMI on this, where you wouldn't have the PMI on the regular conventional loan program under the residential market. Okay, because with 20% down, it does not require you to have mortgage insurance. Okay, better known as PMI, principal mortgage insurance. Mortgage insurance is what FHA call their insurance, which is upfront fee mortgage insurance. Under the conventional end, is known as PMI, private mortgage insurance. I did a show on that maybe about 3 weeks ago. Go to blogtalkradio.com/mortgage talk one. You're going to find some good insight information under there talking about mortgage insurance, PMI compared to MI, compared to mortgage protection insurance. Go back, listen to that. It's on Blog Talk Radio and speaker.com, and just type in the column in there, Mortgage Talk 1, the number 1 symbol, and you can scroll down and you can see that, and you can choose that, and you can listen to that, okay? Some good information right there for you. Meanwhile, the compared program to FHA program, but the conventional program, now they have one without you putting down that 20%, as I mentioned earlier. What is the difference between conventional 97 and FHA credit scoring? FHA credit scoring is 580 to qualify. Now, there are some lenders who will become the servicer for the loan under the guidance rule of FHA, can require, because they're going to be the servicer of the loan, can require you to have a 620 score or a 640 score to qualify. So you can shop around through the lenders. You know, those that do and those that don't, and those will take FHA minimal of 580, okay? Also, upfront mortgage insurance fees will be required from FHA. It's not much. It was 1.75% of the loan, so it's not that much. Now, the new conventional 97 LTV program, it's a low down payment loan with no upfront mortgage insurance, even though you get 97% of the loan and only putting 3% down. There is no upfront mortgage insurance fees. That's a plus factor. And cancel, but you are going to get the PMI, but you don't have to pay upfront. Okay, it'll just be worked into your monthly payments. Whereas with FHA, you got to pay up front, and then when you start making your first payment, then that small percentage is taken out. It is very, very similar to homeowners insurance. Notice I keep saying the word insurance. Everything we do covers in insurance. So homeowners insurance, you pay the first year premium up front. It's always 1 year behind. So you understand that. So with conventional 97, they don't charge you mortgage insurance protection, which is only for the lender, not you. That's for if you default on the loan. Okay? And it's a good package sale for a lender to say, okay, well, I'll loan them money. Even though I got a few challenges or a few nicks and kicks and cuts on their credit report, I normally don't loan money to people like that, but I'll loan you the money because you're going to back them up, Freddie Mac and Fannie Mae, and they're going to have PMI because they're not putting down 20%. So that's a protection right there. Okay, you sweeten the pot. Sounds good to me. Let's sign them up. That's how that goes, okay? That's how that goes. And that was make that a sellable deal, okay? So the conventional loan does not have mortgage insurance fees up front. It also has a cancelability that FHA used to have, meaning that once you pay the loan over the period of time where you pay that loan down from 97% and you drop it to 79% over the years, then the PMI, which is private mortgage insurance, drops off. You will have to put that request in for it to happen, but it drops off. Okay, so you can have that understanding of that. Okay, what that means to borrowers will now here's a good point, will receive the same low rate at a 3% down compared to those that is put down 20% under the conventional market program. You're going to be able to get that same rate. You're going to be able to get that same rate under this program. Okay. So conventional, that puts 20% down. Conventional, 97, that put only 3% down, will still be able to get that same low interest rate. Okay. They'll be able to get that same low interest rate. Those are good plus factors. Now, I'm going to give you an example. For instance, the borrower that's putting 20% down, leaving 80% to go into a loan that they will be responsible for. That's 80% of the sale price that will become their mortgage loan amount. Use the loan balance under a regular conventional. The qualifying credit score is 660. And that's considered a C scale. That's not, at one time, that was considered very, very good. It's not anymore. That's a low score. Okay. But that person that's putting that, but how that formulates, how that works, let me see, can I get that in there? How that works is like you got 80% of the loan balance. You will receive a rate increase of about 3/8 of 1% because of the credit score. You will receive about 3/8 of 1% because of the credit score. Let me say that again. The borrower's putting down 20% down and carrying back 80% in a loan amount. Use for loans a regular conventional loan qualifies at 660 score, will receive a rate increase of about 3/8 of 1% because of the credit scores. Now, a borrower who puts 3% down will receive approximately the same rate. Now, some people, as I beat that just a little bit, is saying to themselves, why? Why is that? How come that's not fair? Did I hear you right? Are you saying this? Do you hear what you're saying? This is done because the facts that the PMI takes away the risks off for Fannie Mae, who is the investor, and the lender, who will become your servicer, packaging that package up, making it a sellable package. If the borrower defaults, the mortgage insurance company will reimburse the investor of the mortgage owner until you pay the investor off. He still owns it. Will pay the mortgage investor, who is the owner, 20% of the sales price. Remember, you only put down 3%. But if you default, the investor, that insurance, that PMI, is going to pay 20% is going to make up for that difference. Okay. Then, are you following me? It's going to make up for that difference for Freddie Mac and Fannie Mae. That's the package to get a lender to sign on and to loan you the money. And for the lender, it's not going to lose anything. All fees, attorney fees, and everything that they went through to foreclose, they're going to send that bill to Fannie Mae. So they have insurance on you, on the property, for a default factor. So they'll get 20% back that you only put down 3%. Okay. They're going to pay all the fees that the servicer has sent over to them. So the servicer is not out of nothing. Win-win situation for them. Then in foreclosure, when they take over the property, they'll sell the property off and recuperate the rest of the loan. Because when they pay the servicer, they're going to pay the servicer for the foreclosure fees and the total amount of the loan that they lend you. You never saw the money. It was just in paper. You just signed for it. So they're going to get all of their money. Okay. The investor is going to get 20% from the PMI insurance company. Insurance company. Then the investor, Freddie Mac, Fannie Mae, will recuperate the rest of their money when the property is sold through foreclosure. Are you with me? Or am I by myself? I heard a wise man say. For you, because no one plans to go into foreclosure. All the necessary steps you have to take and the requirements that I'm not going through because this is the focus point. Don't forget the requirements and under the conventional qualification requirements that I'm going to touch on in a bit, but just the focus points. The conventional requirement is 36 over 24. What does it mean? Well, what that means is that you take your monthly net income, okay, and you minus your bills that you're currently paying. It cannot supersede 24% of your monthly income. I said monthly. Now you're purchasing a mortgage or purchasing a property and going to sign a promissory note and the mortgage deed, which is the property that you put up for collateral. Okay. Your total expense along with the new mortgage payment cannot supersede 36% of your monthly income. Got me? Those guidelines are the guidelines for conventional loaning. And this is indeed a conventional loan, just with a little twist. They're offering you 97% of the loan amount. Okay. In that same process, you are required to have at least 6 months of the potential mortgage payment in your reserve account. Also, what your future light, gas bills and water bill is going to be also is required to be in your reserve. Don't panic, because reserve can come in so many forms. Because if you have a whole life policy with a cash buildup, that could be your reserve. If you have a IUL, index universal life policy, that has a stronger interest return, and where you never will lose any of your initial investment if the market falls, because your money is never in the market, it just mimics the market. It's tax-free. Okay. You can borrow money from it and don't have to pay taxes on it. It's tax-free, and the payout to your beneficiary if something were to happen. You don't even have to pay the loan back, but it will be adjusted when you decide to close out that section after you pay for the policy, that section, that cash reserve section, then it will minus that out of there. If you borrow money from anybody and you got to pay it back, how come you don't want to pay back yourself? Something's wrong with you if you don't want to pay yourself. You should always practice with that, paying yourself. Pay yourself first, and then that will never become an issue for you. Okay, just a little word of advice. That's all. So with this, you have those reserves in place. Those are stipulation qualification, and you can use your insurance policy for that. Term policy does not have a cash buildup, so you cannot use a term policy. Okay, it don't have a cash buildup. That's a no. You cannot use that. All right. Yes, I have heard of some term policies that has a rider with some particular carriers that will offer that. And that's coming for term policy. And if you have that, can you use that cash reserve if it's enough to qualify you for that 6 months reserve that you need to get a conventional loan? Question with that is, yes, you can. Okay. Because you have a cash buildup on that. If you have a bond and the bond is more than enough for that, you can do it too. And there's all types of different bonds that has high yield returns for you. Okay. Some of the city bonds have high yield returns. All right. So again, yes, you can use those. All right. If you don't have the liquid capital in the bank, you can use those. Okay. So just to let you know, got to move on. Mortgage protection. You should always require mortgage protection insurance for yourself because it's for the living, as well as protecting your family if something were to happen to you. Mortgage, remember, everything is insured. You see how the lenders are doing insurance. You see how your investor got insurance. Okay, everything is insured. You have to have car insurance, don't you? Everything is insured. You bought some appliances. Okay, it's insured. They sold it to you as a warranty. Warranty is a beautiful name, but it's insured. It's an insurance company that offers it. Okay. Those extended warranties are offered through insurance companies. All right. I'm not going to get into that contents of it because it starts the same time that your 1 year warranty starts. When you buy that 2 year extra, you think you got 3 years? No, you don't, because that 2 year, that first year is going to merge with the manufacturing. And then when the manufacturing warranty first year has expired, your extended warranty first year expires too. Now you only got 1 year left. Okay, just thought I'd just share it with you. So many of today's homeowners, buyers, will meet the guidelines for this conventional 97% loan. Some of the options are that the mortgage is a fixed rate loan. The property is a 1 unit single family home or a co-op or a condo or a pub. at least one buyer, if there's more than one buyer, because sometimes they are, at least one buyer or the single buyer has not owned a home in the last 3 years. You can qualify. The property will be the buyer, the new owner, primary residence. And you will sign a documentation at closing stating that this is not an investment property, that you agree that this is going to be your residence. Please note what that document is going to consist of. Because if you lie on that document, they can call a loan due. Okay? I just want to let you know. Got to move on. The loan amount will not go above $548,280 under this program. And this amount is sometimes the main ingredient for some buyers. I'm a conventional person. I got good credit. But the home that you're buying may supersede that. So this program is not the one for you. Okay. You may have to get that conventional jumbo program that has a higher interest rate. Okay. Or you may say, well, let me look over here to FHA. Whereas FHA limited exceeds over 800,000. And you don't have to get a jumbo. Because under their program, the jumbo has been merged in. So this usually becomes a deciding factor for some buyers. Okay. Just thought I'd share that with you. Now, these features, this program, the conventional 97 loan program, and the qualification features aligns well with a typical first-time buyer program. Most first-time buyers are looking for single-family homes. High statistics shows that they are. They show that they don't be looking for a duplex and 3 flats, or what they call a triplex. They don't be looking for that. They be looking for single family home. I did not say that you don't have them out there that do. I'm saying that the statistics for them when they buy their first property is normally a single family home, and statistics shows higher than it do for a 2 flat, which is a duplex, or a triplex, which is a triplex, which is a 3-unit building. Okay, and they are looking to purchase at a lower price. That's what first-time home buyers be looking for. Okay. Now, according to Fannie Mae, the loan level price adjustment, the acronyms of LLPA, that chart shows that the borrower can have a score as low as 620 to qualify for this program, and still qualify when you make that comparison at a traditional conventional loan, which is set at the credit scores, is set between 640 and 660. but yet you need only a 620 to get the Fannie Mae conventional 97% loan. You just need a 620 credit score, and you can get it. Okay. Now that the mortgage rates for the 3% down program are based on the standard Fannie Mae and Freddie Mac rates, plus a slight rate increase. When you make the comparison to the others, it's still low. But these loans will come within a rate only about 1/8 to 1/4 of 1% higher than the rates available to borrowers that's on the market for those that are putting 5% and 10% down. Okay. Are you with me? Or am I by myself? I heard a wise man say. The borrowers buying a $250,000 property, I'm giving you an example here, would pay about $60 more per month by choosing the 97% loan compared to a person, a borrower or borrowers that put down 5%. This means the buyer reduce their total upfront home buying costs of approximately $5,000 in this program. So you may pay $60 a little bit more a month in a comparison to a buyer that put down 5%. You may pay $60 a little bit more than they do, but you save over $5,000 just in upfront fees, whereas they didn't. That's people look at those things, and I'd rather save $5,000 out of my pocket now up front and pay $60 more for it and not get into a tug of war with some of my conventional buying friends who feels that they are stronger educated consumer than I, because I'm paying 60%. Well, not 60%, but I'm paying $60 more a month than they are. But did you just get to hear me telling you about the benefits that I reap in this? I got 97% of the loan. You didn't get a PMI. I got a PMI. Okay. But after I pay the loan down to 79%, I can cancel that PMI. And I save some of my money because I only put 3% down and cover the small closing costs. You put down a lot of money because you had to put 20% down of the sales price. And I gave an example of $250,000, which is the average cost for some of the homes in today's market. I didn't say you can find a home less than that. I said it's an average cost in the day's market. I can really get specific by saying that it fits square footage between 18 to 2,500 square footage. I can play particulars if you want me to. But that is the average statistical cost of a home. Okay. For 2020, even though it is 2021, those statistics are not out yet. But the borrower saved $5,000 from upfront fee. That's $5,000 that stays either in his cash reserve in his insurance policy that's going to pay higher interest rate per month than any bank can pay you. The bank only going to give you 1% 8.1%. And here you have it in an IUL that can give you as high as 9% to 14% or 16% of your money. Interesting. Protecting you and you lose nothing. Or you have a universal life policy that's crediting you 6.5% or 5% or 4.75%, still higher than any bank would give you when you have your $5,000 sitting in your savings. And you wonder why you don't find Rolls Royce and wealthy people standing in line with you to get money out of the bank. By the time that the buyer, if he decides that I might just save up the other 2%, by the time that that buyer realistically decides to do that or think, should I do that, the sale price is going to be up because it's going to take him a while before he can get that extra 2% of the sale price. What is 2% of a $250,000? He's not going to be able to raise that money in no 2 months. Now let's say you have a particular job, maybe the stock market job, okay? Then I would say, yeah, he can do it. So go ahead on and do it. He don't even have to do the program. He probably just do a regular conventional loan program and just pay the 20% down because he gets higher commission, yield returns. Or he has another job, an engineer, that he can raise this money within 30 days or even borrow the money. Okay. But most people don't have the money. So they're going to have to work another year to get it. And the point making is that the market is going to change, and it changes every year anyway. So what will happen, the interest rate will probably be higher. And the required down payments is still going to be the same, but the interest rate will probably be higher. The purchase price will be up. So you're going to equally balance out for that year. Whereas now you got interest rate at the all-time low. It's not going to be like that no more. And once COVID-19 is up and many wonderful Americans have been vaccinated and the economy is picking up stronger and stronger and stronger each day, each week, each month, what you're going to find is that prices of real estate is going to go up a little bit more. Okay. Just want to just throw that out there. That's all. Now, here are some concerned questions. Now, when I posted I was going to do this show, some of these questions came in, and there's a few of them that I saw that someone had asked that question through one of the internet writers, and I took that question because it made sense, and it's the type of questions that you, the educated consumer, will indeed ask. And I wanted to incorporate that into some answers for you for the Freddie Mac and Fannie Mae conventional 97% loan. Here's some of the questions that has come about. Can the buyer buy a condo or a townhouse with the conventional 97% loan program? Well, I answered that question earlier, but I answered again. The answer is yes. The buyer can purchase a condominium or a townhouse or a co-op as long as it is only one unit. He can purchase that, or she can purchase that under the conventional 97% loan program. Next question. I own a house for 2 years. Well, I own a house for 2 years ago, but have been renting since. Will I qualify for Fannie Mae's 97 conventional 97% of the loan? Will I qualify? I own a house for 2 years, but have been renting since. Will I qualify? Answer: you must wait for 3 years have passed since you had any ownership in a residential home. At that time, or at that point, I should say, you are considered a first-time home buyer, but you gotta wait. And you will be eligible for the conventional 97% loan. Next question. Can I get a conforming jumbo loan with 3% down in the conventional market? Answer to that question is no, you cannot. Because there are loan limits. Conventional loans have loan limits. This conventional 97% program also follows that guidelines of Fannie Mae and Freddie Mac, and it holds that loan limit. So this time, the high balance, also known as conforming jumbo loans, those that are over, the amount is over $548,200 are not eligible. Did you get that? You might want to think FHA. That's why it's good to know about these programs, because they propose different options. And a lot of people, this option is going to work so well for them. And a lot of them it's not, because they're looking at a jumbo loan. Well, if you're looking at a jumbo loan, you need to look over there at FHA, because you're not going to find it on this conventional loan 97 program, or on any conventional loan program, because the max dollar amount that you can't supersede is $548,250. If you supersede there, you won't be eligible. Final question here. I've been approved for a conventional. Instead, can I do that? Young lady, I see your name, and I saw that you just called, but I'm just about to wrap this up, and I'm more than happy to call you back, and I will call you back. But I was unable to text you and your question, and it's real interesting, because the last question is very close to the question that you wanted me to answer. So I'm gonna read the question again. I've been approved through a conventional loan program that required me to put down 5%. but I want to switch the program because I don't want to put down 5%. I like that 3%, and I want to put down that 3%. So I want to switch that regular conventional program. I want to switch that over to the conventional 97% of the loan program. I want to switch over to that program. So my question is, can I do it? I already been approved. Can I do it? Answer to that question is yes. Yes, you can. Yes, your lender, your servicer could re-underwrite. They have to do that. Re-underwrite your loan if there's an offer program. Keep in mind that your DTI is going to be weighed on that. And as long as you meet that DTI requirement, you can switch over. It's not a problem, okay? Because the DTI also, because you're switching over and taking away that 2%, it can also affect the interest rate. It'll be just a tink tab a little higher, maybe a quarter of a point higher, okay? So just be aware if you are under a 5% conventional loan and you just found out about the conventional 97% loan and you want to switch over, you can switch over. The interest rate is going to be just a tink a little bit more, okay? And as long as you is well within that DTI, and if you got the 5% down, then you are automatically well within that DTI. So that's not going to become an issue, okay? Okay, that's not even become a thought. What you have to look at is that the interest rate may be a quarter of a point more, okay? And so you have to, deal with that. There's a lot of people that are very stickler over that. And there are people who are so stickler over that until they know how to negotiate interest rates based off the index. They know exactly what the bank paid for that rate on the market, and they know how to go in and negotiate because they understand index and margin. I did a show on that through blogtalkradio.com/Mortgage Talk 1. I think I did about 6 years ago. And so we only talked about the index and the margin that tells you this is how interest rates are formed. This is how they're able to determine what the rate is. So we talked about that, okay? So we're going to do an updated show because there needs to be a updated show happening for 2021. And so stay tuned for this channel right here on HAP TV and Twitch TV and YouTube, that you're going to see me talk about the index and the margin, so you can understand how they formulate those interest rates, what is the process of that. So, because remember, this is all help formulate that educated consumer, which is indeed the best customer. I hope this has been helpful for you, and I hope I have explained it well. My producers be telling me, Rick, you need to cut down a little bit because you talk a little long. You need to cut it a little bit. Okay, because I really get excited and I really get into it, and I really want you to understand and get this. You can always email me on mortgagetalk1, the number one symbol, at gmail.com. That's mortgagetalk1, the number one symbol, at gmail.com. And you can ask any questions on that and even make your suggestions on some shows that you want to see. Or you can go to my website and you can do it on Mortgage Talk Facebook page. Okay. And Mortgage Talk Facebook page is www.facebook.com/Rick in small letters Montgomery /370-177. And and you'll be in and join me on Mortgage Talk. Join me. Or you can go to WHPNN Radio Network Facebook page, and you can join WHPNN Radio Network Facebook page too. I encourage you to do them both. You're going to get some good information off both of the website. But come follow me on our Facebook page and follow me there. Rick Montgomery's Facebook page is maxed out. I need my son to show me how I can set it up for people to follow me. I still haven't got that yet. Hey, okay, I'm in the old school end. I'm 62. But these young kids, they really got it patterned down, and they can really do it. And so I don't mind saying, hey, I need your help. And you should see them. When I ask them about helping me on certain things, you don't know. I know something that you don't know. You don't know. You know, it just really thrills him to be able to have that. And what he don't know is that I get excited too, you know, and it's a good thing, you know, to learn from the younger generation too. You know, you never stop learning. You know, even at our age, we never stop learning. And I know we have the advantage, and we are teaching our children, you know, the mistakes that we made, the mistake that grandpa made, the mistake that grandma made, the mistakes that our friends made. Don't you make the same mistake. We're giving you a blueprint. Follow that blueprint. And sometimes we can come off like a know-it-all, even though we're not trying to be that know-it-all. We're just trying to protect our children or our child. Okay. So stay good, stay warm, stay cool, stay excited. Go out and get your American dream. This is what this program is all about. This is what Mortgage Talk is all about, helping you to obtain your American dream, okay? And to keep you and to help strengthen you as that educated consumer, which is indeed the best customer. We'll see you on HAP TV again with some more mortgage information. Oh yeah, trust me, I'm coming with some more mortgage information. But for now, thank you for being my friend. Thank you for listening to me, Rick Montgomery. And thank you for listening to Mortgage Talk. We're going to see you. That's the charm, letting me know that it's that time. And so we're going to wrap it up with you and close out the show. Thank you for listening to Mortgage Talk. We'll see you next time. Good night, everybody.
I hope this information is something that you can use for your mortgage needs. Remember to tune in next week at the same time for more Mortgage Talk. God bless you.